Hello, my name is Jason Thomas, and I'm head of global research at Carlyle. I'm here today to discuss our use of private data and the future of private markets. As a result of Carlyle's massive global footprint, we have access to thousands of data streams unavailable to anyone else that provide real-time insights into the state of the global economy and trends in the investment environment. We subject these data to learning algorithms to separate the portion that is company-specific from that which is macroeconomic in origin. We then use the outputs from those models to inform investment decisions, aid portfolio construction, and also deepen our relationships with our largest limited partners. Our analysis focuses primarily, but not exclusively, on our global private equity portfolio, where our influence or control allows us to access whatever data we want: orders, shipments, inventories, pricing trends, from hundreds of businesses operating in industries all over the world. We're able to collect these data on a relatively high frequency basis. That means we're able to get data every week, every month. In some cases, we look at data every day. And this provides a great snapshot of what's really happening in the real economy. As you can imagine, this was extremely valuable in 2020. Now, lockdowns today for all of us are old hat. We've been through them. We understand their implications. But entering 2020, it was virtually impossible to imagine a sudden cessation of economic activity, particularly one that would last for weeks on end. Yet that's exactly what we saw in China, when starting at the end of January, logistics volumes in the portfolio fell to zero and stayed there for about 3 weeks. This was shocking. We'd never seen anything like this. But the shock value of the data actually was really important for preparing our teams in North America and Europe for the risk that they were facing, what could ultimately come, and also preparing their portfolios for that eventuality. These weekly data have also been very valuable to observe the recovery in China. Sometimes official data in China, of course, not as reliable. These data have also helped us see how households and businesses in the US and Europe have adapted to the pandemic. That's both in terms of productivity working from home across the portfolio, as well as trends in online sales and then associated logistics volumes. But we don't stop with raw data. We have models that decompose each time series we look at into the company-specific components and then the macroeconomic exposures, in some cases, a large number of macroeconomic exposures for a given company. This allows us to then back out implied economic growth rates by industry and geography as the data come in. But more importantly, this search for common trends that exist between portfolio company series and between official statistics allows us to have a very powerful tool to detect inflection points and also to test investment and macro theses. For example, we have enough data to replicate virtually any macroeconomic time series of interest: Chinese retail sales, India's GDP, US industrial orders, using an optimized combination of portfolio company data. We also are able to characterize virtually any portfolio company series as a linear function of macroeconomic exposures. So that means if you were looking at a European-based business that is exposed to consumer electronics value chains in Asia, we're able to more precisely characterize the macroeconomic risk facing the business, the underlying growth rate in the demand drivers, and then also the volatility and cyclical sensitivity it's likely to experience over a relevant holding period. If you're thinking about portfolio company data as a linear combination of macroeconomic exposures, also aids portfolio construction. Because in addition to thinking about the diversifying effects of size, industry, and geography, you're also able to look through and see the correlation in the underlying macroeconomic exposures. So this really provides some visibility to have a sense of what types of assets are likely to perform best together. That's helpful for funds. It's also especially important when helping large institutions assemble their portfolios of private assets. Of course, some of the predictive insights and data that these models generate are relatively short-term nature. That means that they're not actionable for private investors with long-term holding periods dealing in illiquid markets. But these data are greatly valued by large institutions who are always seeking incremental information to help them make better investment decisions. And so we believe that by providing these data, the associated insights, we're actually able to deepen relationships with large institutions and ensure that Carlyle captures a large share of their increased commitments to private markets over the next 5 to 10 years. And make no mistake, commitments to private markets are likely to increase substantially over the next 5 to 10 years. And that's because the private market premium, essentially the return in excess of that available from public markets, has gone from about 20% of total returns 20 years ago to as much as 2/3 of total returns over the next 5 to 10 years, as very low interest rates and very high valuations depress return expectations in public markets. So today, the private return premium has gone from something that was nice to have to something that is absolutely essential if these institutions are going to hit their return targets. Now, I think this raises a very obvious question. If all of this money comes pouring into private markets, won't this incremental capital just bid up the price of assets and essentially erase this return premium? The answer is no. And the reason for that is because the growth in demand for private capital among founders, entrepreneurs, management teams has actually exceeded cumulative inflows into the asset classes. So really, when you think about the private market opportunity set, essentially the number of companies seeking private capital, that can expand in ways that accommodate very significant growth in private markets without any diminution in relative returns or that return premium. When we think about private markets and their evolution over the last 20 years, it's important to remember that these markets were once really a barbell, which is to say that you had at one end a very active, very robust, early stage venture market. At the other end, you had a very robust, late stage buyout, principally delistings of public companies. So in this kind of environment, when a business attained a market value of, say, 500 million, they really had no choice but to go public if they wanted incremental capital to grow. And they probably wouldn't be a candidate for private capital again until they were a relatively old public company that had some missteps or otherwise needed to go private to change strategy or reposition itself. The market has evolved over the last 20 years so that private capital is now a comprehensive alternative to public listings. Private capital is available on very competitive prices and very efficient, very fast processes at virtually every stage of a company's life cycle. So really, when we look at the fourfold growth in the asset class, it's almost entirely explained by private investments in private companies. And the fact that these investments are alternatives to public listings is also reflected in the fact that IPOs of operating companies have dropped by 75% over the same period. But this isn't just about options or alternatives or choices. It really reflects the economic fundamentals. Today, business value, business investment increasingly depends on intangible assets, proprietary technology, business methods, algorithms, really ideas. These assets are very hard to value, but they're also very easy to steal. And so these companies, digital businesses, they can go public, they can access public markets, but doing so means that they have to provide fulsome disclosures, maybe go on roadshows to explain how their technology works, the market they're seeking to disrupt, their current R&D programs, really just all the information that's necessary to assign a value to these businesses. But of course, doing so in a public forum would almost certainly get back to competitors or would-be competitors. So these businesses today rationally choose to access the same capital confidentially through non-disclosure agreements in private markets and push off that public listing until they've attained the relevant scale, user base, or brand identification, where a public listing would then make sense. And so as a result of this pushing off listings, the typical business today goes public at 9 or 10 years after founding, rather than 3 to 5, as was the case 20 years ago. And in fact, when we look at the businesses overall, successful growing startups are more likely to be private after 14 years than they are to go public before 3. So the market has changed quite dramatically. But of course, in these markets, value is a function of time. So the longer the company stays private, the more value that accrues to the private investors. For example, last year, tech companies that went public in the United States were 17 times larger in terms of trailing revenues than was the case 20 years before. So these companies are much larger and have accumulated much more value. More of that accumulates to private market investors, about 83% of the total, based on a recent sample of businesses. So a typical company today could have 4 or 5 or even more private investors over its lifetime. They may undergo 2 to 3 buyouts during this period of private ownership before ultimately going public. It's important to note, we're talking about the supply of IPOs, not the demand. Because as we look at data over the last year, it's very obvious that when these companies are ready to go public, the demand for their shares is as strong as ever. So valuations of the businesses with over $1 billion private valuations that went public, their offer price was generally 2 times the value of their last private round or last private investment valuation. Then, after going public, these companies typically traded up by another 100% in their first week as listed securities. So these data really provide very powerful evidence that that liquidity premium, the price of public versus private assets, is as wide as ever. And that really very likely reflects this cumulative shortfall in IPOs we've observed over the last 15 years. Now, I think it's important to note, as Mark Jenkins alluded earlier, the growth in private credit is where the overall growth in private markets is probably going to be most visible over the next 5 to 10 years. That's because private credit starts from a relatively lower base and actually has much more room to grow. Also, although the growth in private credit has been impressive, to date, it's really only been sufficient to offset the very sizable decline in credit market intermediation provided by investment banks and broker-dealers, which of course has contracted massively since the global financial crisis. So just to conclude, we have more data and we make better use of it, which helps inform investment decisions, improve portfolio allocation, and also deepen relationships with our largest investors. We expect private markets to grow substantially over the next 5 to 10 years, but people needn't worry that that growth lead to a compression in the return premium, because the growth in demand for private capital among founders, management teams, entrepreneurs has more than kept pace with those inflows. Thank you so much for your time.